But man, when you're getting a lot of money taken out in taxes, you start really feeling it. And then you want to get as many ways to get out of taxes as possible. So I brought my good friend on, Adam, who's going to walk us through all these great things about getting out of taxes. But at the same time, we have a free download for you to be able to get a big long list, cheat sheet of all the things you can write off. So, Adam, really appreciate you jumping on the show and or this workshop. And I'm really glad that we have such a great company as NCH to help us. So, Adam, take it away, man.
You got it. Thank you so much for having me. I appreciate you guys taking time out of your evening to be here. I promise not to bore you. Taxes and talking about taxes is never a fun subject. But as Dustin said, you get taxed every which way. And if you do nothing, the government will take as much as you give them. Judge Learned Hand said, "It is not illegal to arrange your affairs in such a way as to pay the least amount of money in tax as possible." So that's what I want to help you do, is to make sure you're getting these things organized, whether you're just getting started, have a business, don't have a business, you have a couple rental properties, you have a lot of rental properties. There's ways we can structure these things that will really give you an edge and help you keep more money in your pocket. So let me share my screen here. I'll get my presentation up, and let's see, I'll share that, and we'll come back to.
And so, Adam, while you're doing that, I know everybody's going to have questions. I want you to put them in the chat. I'll be monitoring the chat. And so, if I can answer something, I definitely will. And at the same time, we're going to have questions at the end because he's got a lot to go over. You're going to be able to download everything. So, definitely utilize the chat. That's what it's for.
Yes. Hey, let me fix my screen so if you can see the bigger version of it. All right. All right. So we'll start at the from the beginning here. So the topics that we're going to cover today is really how wealthy people keep more of their money, and we'll talk about the active income and the passive income. We'll talk about record keeping, making sure you're keeping accurate records, tax planning opportunities. There's a strategy called buy, borrow, die, whereas you start building out your wealth, you start accumulating equity in properties. We can borrow the money from the equity in those properties, and it's a loan from the bank. We don't have to pay any taxes on it. And eventually, when you die, we'll be able to pass those assets on to your children. And again, we do this right. Um, your kids are going to inherit your property with a step up in basis, incredible tax savings opportunities. And then finally, we'll talk about CRTs, charitable remainder trust, and family foundations. So I just want to start with laying a foundation. If you don't have one, really a good idea, get a limited liability company established. They can work for just about anything. They're great for partnerships, single members. If you have partners involved in business, it protects all the partners involved, really flexible for dividing out profits. Single member LLCs, there's no additional tax forms to file for them. It is really the perfect tool for real estate investors. So if you don't yet have an LLC established, we live in a world that it has gotten so far away from suing someone that's done something wrong to just trying to tie in deep pockets. And we want to make sure that you are not the deep pockets. As the saying goes, own nothing, control everything. And if we can get your entities and your trust established properly, it's really going to give you an edge. So there's a lot of tax benefits that you get. And just as an individual person, there's all these things that you can write off. But as a corporate entity, depending on the type of business you have, there are additional tax savings benefits. So I'm going to teach you tonight what to do and when to do it. When should we use an S Corp? When should we use a partnership? When should the LLC be disregarded? And we're going to talk about what records you need to keep so that you're doing these things right. So I don't need you to be accountants and CPAs, but I want you to understand the basics of how these things work. So if you were to set up a corporation would file Form 1120. That will be a C corporation, which is all the big companies, Microsoft, Walmart, Disney. They're all set up as C corporations. The problem for a small business is double tax. Your C corporation makes money and it pays 21% federal tax. Then I distribute the profit to you, and you've got to pay a capital gains tax for receiving a dividend. There's these double taxes. So we rarely use C corporations. unless you're a big business, you're going to take your company public. Those are typically when we use a C corporation. So most small businesses are going to be taxed as an S corp, and that files Form 1120S. Now, when you form an LLC, we got four options. If I wanted, I could file Form 8832 and elect for my company to be taxed as a C corporation. It would file Form 1120, exact same tax filing as a C corporation. Or I could file Form 2553, elect to be taxed as an S corporation, files Form 1120S. If you have partners involved, we elect to be taxed as a partnership, it files Form 1065. If you form an LLC and you make no tax election, the IRS considers that to be a single member LLC disregarded for tax purpose. It doesn't file a separate tax return. They expect that all profits and losses just report on your Form 1040 exactly the same as if you did not have the LLC. And there's a time where that does make sense, but just depending on what you're doing. So when we step back and look at how we got to get things organized in our mind, is there are two types of income: passive income and active income. Now, passive income is any investment. You buy a property, you put it on the market for rent, you hold the property for a year and a day. That is passive income. Or you buy stocks. You're holding them for a year and a day. That is passive income. Your rental properties are all passive income, which automatically gets offset by passive losses. And it is one of the most wonderful things about owning real estate. You do nothing. This happens automatically. When you get your taxes done, we get to depreciate the property. We get to write off the principal, interest, taxes, and insurance. That's all part of our passive loss bucket that offsets the passive income. Active income is you're working to make the money. Short-term investments, if you do any rehabbing, wholesaling or rehabbing, that's a short-term investment. If you're a real estate agent, you own a construction business, that is all active income. Or if you're a private lender, you're charging points plus interest. The points are considered active. The interest income is considered passive. So we've got to keep these things separate, and you never, ever put passive income and active income inside the same company. It will cause all kinds of tax problems. So if you have a business and you have passive income and you have your LLC, you've got to keep these things separate. So just earlier today, I was talking to a guy. He works in Alaska. He's got a big fishing business where they go fishing, and he makes really good money. He said, Adam, I've had my same CPA since I was 15 years old. Same guy. And he has his LLC. So I pulled that up, and he said, yep, you got the LLC there. Are you being taxed as an S corporation? He said, Adam, I have no idea. I let my CPA handle all of that. That is a huge mistake. So this guy's been operating now for 20 years, and he was just operating as an LLC that was a sole proprietor, and he's getting hammered in tax. He said, Adam, I really like the guy. Been working with him since I was 15 years old. He does work for my dad and does work for me, but these other people I talk to, they've got guys that seem to save them a lot more money in taxes, and I've just been hammered with taxes. Well, I'm going to share with you why and what happened. So on all the income he made, he was subject to state, federal, and social security and Medicare tax. So if you have an active income business, again, you're a real estate agent, you're a fisherman, you have a business where you're actively working to make the money, you're paying the state, federal, and social security and Medicare. Now, you can reduce what you owe in state and federal tax based on your personal deductions. You own your own home, you have kids, you put money in retirement accounts. You might not pay a whole lot in state or federal. What you cannot reduce is that darn self-employment. It is 15.3%. Now, when you're a W-2 employee, your employer pays half and you pay half. When you're self-employed, you pay all of it. And this year, it is the first $176,100 that you make. You're going to pay in 12.4% for Social Security, and then the 2.9% for Medicare goes on all the money that you make. That's a total of 15.3%, which is a killer. All this person would have had to do, so I told them, all right, what we need to do immediately is you might want to consider finding a new CPA because when we look backward at the number of years that you've been operating that business and the amount of money that you have overpaid in taxes is going to make you sick. Let me show you how this works. So active income, we're going to keep track of all of our expenses. And I strongly recommend whether you have a business or you have rental properties, we want to track these things separate. So active income or passive income, do just a simple monthly expense report. There's a lot of apps, QuickBooks or Expensify. There's a lot of apps you can use to track expenses, but you're just going to have 4 simple columns. So top of your page, January expense report, 4 simple columns, date, dollar amount, who you paid, and a brief description of what it was for. Um, if you have a home office, if you want to write that off, you can, but there's a couple problems. One is there's two ways you can do a home office personally. You have the safe harbor method, which the IRS gives you $5 per square foot up to 300 square feet. So you can get a $1,500 deduction. They call that the safe harbor method because it doesn't report on your personal return. There's no red flags or anything like that. Or you can do the actual expense. Well, for the actual expense, normally that works out to be much better. If you have a room that has your desk and a computer, that is your home office. So when we calculate the home office, we say your room and there's a hallway that leads to a bathroom. We get the room, the hallway, and the bathroom. If that works out to be 15% of the square footage of your home, your company is going to owe you 15% of your monthly payment and 15% of utilities, electric, gas, water, and sewer. Keep those receipts. It's a great time to be talking about this. You can do it properly throughout the year. So that's your home office. Meals. If you go out to eat by yourself, you cannot write that off. You have breakfast, lunch, or dinner with anybody else, including date night. Long as we're talking business, keep those receipts. We get 50% of meals. Mileage or travel is huge. So I recommend all of you write down the app Mile IQ, MILEIQ. Every time your car starts moving, it knows you're on a trip. You tell it business or personal. At the end of the month, it'll send us an IRS compliant miles report. We get 70 cents per mile. What I love about the app, you might forget to write something down because the IRS rules are you have to have a miles log with start, stop, total miles driven, and purpose of the trip. And some people are a-okay doing that. I am very forgetful. So having that app, it tracks everything and you just categorize if it was a business trip or a personal trip, makes things a lot easier. At the end of the month, it'll send you an IRS compliant miles report. We get 70 cents per mile you drive. If you're doing any training, we have events coming up and you want to fly out to a seminar, your airfare, hotel, meals, lodging. By the way, meals you got to be eating out with somebody else if you're within 100 miles of your home. If you travel to an event outside of 100 miles, then you don't have to be eating out with someone else. You'll get 50% of the meals. So I always recommend for meals, always put your name, the name of the person or people you had the meal with at the top of the receipt, and just put marketing meeting. We get 50% of meals. So your travel expenses we can deduct. If you have to buy any equipment, a new desk, new computer, new phone, any of those things, your education and training, if you have any programs that you're investing in for education, we get to write those things off. I will point out that is on the active income side of the business. On the passive income side, I need to track my properties on a per property basis. And really, all of your expenses for that are broken down into 2 main categories: repairs and maintenance and capital improvements. So the repairs and maintenance side of things, it's very important because if you had to go fix a window, I don't know, I've got 6 boys, and remember one time my son I was out traveling and I come home and my son, they had been throwing the football between the upstairs and downstairs, threw the football right through a window, and my son calls the dad. I called 5 different companies. I got 5 different quotes. And this is when he was 8 years old. He said, I asked them all if they were licensed, bonded, and insured. I've got you a list, Dad. So repairing that window, that was my home. So a little bit different ball game. On a rental property, you have to repair the window. you get to write off 100% of that. Versus if you put all new windows on, those are capital improvements. If I had to repair a roof, I get to write off the cost to repair the roof. If I had to put on a brand new roof, that goes into the cost basis. It's a capital improvement. You can't write off the full cost right now. It gets amortized over a period of time. So travel to and from your rentals. Keep track of your mileage, whether it was in town locally or if you had to drive, 250 miles. Keep track of that. 70 cents per mile we're going to put on the tax return. And when you're looking at properties, if I'm traveling, if I'm going to fly out to Alabama and look at a property, I'm going to keep my airfare, hotel, meals, because I can write that off. It goes into the cost basis of the property if I end up buying it. Um, if you are a disregarded LLC, all of these expenses will land up on a Schedule E. That's where we itemize each property. And that's why I've asked you to track all your properties on a per property basis. Don't lump all your stuff together. I need to know per property what's coming in and what's going out. So if you have a partnership, you get a K1. And the way it works is your 1040 Schedule E, you've got part one, which is where you're itemizing out those properties, versus if you have partners involved, you get a K1 that goes on part two. They're all passive losses, but just done a little bit differently. And I remind people always, your CPAs are only as good as the records you keep. So we talked about doing a monthly expense report to track these expenses. If you have a business, we're going to keep that January expense report, itemizing these things out. And the IRS rules are you must keep contemporaneous record keeping. So that means you just need to do it as you go. And I'm sure a lot of you know people that say, oh, I just keep a shoebox full of receipts. Tax time rolls around, I go back and add everything up. And I promise you, that's not the best way to do it. If you can get a system in place and keep these things organized monthly, it makes it so much easier when tax time rolls around. We need a physical copy of the receipt. Electronic copies are okay, whether it's a physical copy or electronic copy, but we need to have the itemized receipts for the various things that you're doing. So get systems in place now and start these good habits because again, it's just going to save you a lot of time and a lot of money when it comes to doing the taxes. So we're talking a little bit earlier about repairs and maintenance and capital improvements. I want to get a little more detailed about that. So the capital improvements, I gave the example of putting on a brand new roof. That is a capital improvement. It's an amortized. It improves the life of that building. So it is improving the useful life of this structure. That will get amortized over the cost basis, 27 and a half years. So every year we get 3.636% as our depreciation on residential real estate. So and this happens automatically, but this is why it's so important. If you had to go put brand new carpet in, I got to know that because that is a capital improvement versus if I am just repairing some carpet or just having it cleaned, that goes under my repairs and maintenance side of the bucket. So it's so important. If you put in a new addition, I talked to a lady this morning that she inherited a property. It needs a lot of work, but it's a 1.5 bathroom and she wants to use one of the bedrooms and add in a bathroom so she can put the property on Airbnb. She's got to keep receipt because when she puts the bathroom addition, that is going into the cost basis of the property. And because she just inherited it, it's not on the market yet. So this is also important. Is if the property in service, that makes things a little bit different than if the property was not yet in service. So we got to keep really good record from an accounting standpoint. She's going to do all these improvements before she puts the house on the market for rent. That is all going to go into the basis of the property. And we talk about the basis, that's what you paid for the property. Generally speaking, if you bought a house for $200,000, that is your cost basis. If she comes in and puts $25,000 worth of work into it, now her adjusted basis is $225,000. So when she puts a property on the market for rent, that $225,000 is what's going to be amortized over 27 and a half years. So these are all really important things to keep meticulous record and keep it in those two buckets. capital improvements, repairs and maintenance. And this is where having a good CPA really makes a difference. Because if you calculate these things the right way, you can save a bunch of money. If it is calculated wrong, I can't tell you, I work with a lot of people that do mortgages. And when they go to get their mortgages done, they go to get a mortgage on a new house and they didn't put these things properly on their tax return. So you go to get a mortgage and you feel really proud of yourself because your tax return showing you didn't make any money. And that was the goal. You wanted to show no money so that you're not overpaying too much in taxes. Yet, because you did this stuff wrong, uh, now you're not showing any money. Not only was it wrong, but now you're not bankable, and I can't go get a loan on a property even because I'm not showing any profits or incomes. So these are where talking with your CPA can really make a big difference in how you're calculating things. Because if I'm getting a 30-year fixed rate mortgage, I got to show income to be able to justify that versus if I'm getting maybe a DSCR loan, debt service coverage ratio. They don't want to see my tax returns. All they care about is what's the value of the house and how much rent is coming in. So start, if you haven't, start keeping these things organized. So this lady I talked about that she's going to do a little bit of addition. Her property is going to be worth 225,000 will be the basis on the property. And once she puts the house on the market for rent, you'll notice a lot of people, like on a new build, it doesn't have any appliances in there. I did a new build and I wait. Once I put the house on the market, then I go and get my appliances for two reasons. Reason number one, I don't want to get stuff to get stolen when nobody's there. And number two, because if I buy the appliances after I put the market on the house or put the house on the market, then I get to write off my appliances over a 5-year period. That refrigerator that cost me $2,000 for a refrigerator. Now I get to depreciate that over 5 years. So I divide the 2,000 divided by 5, and I'll get $400 in depreciation for the next 5 years on that refrigerator. Versus I put the refrigerator in before I put the house on the market. Well, my basis just went up. That $2,000 I now have to amortize over 27 and a half years. So we can strategically look at these things in terms of how we're doing this. And it's so funny. The IRS, this is from their website. It says typewriters, calculators, and copiers are a 5-year property. They're behind the times for sure, but this would include carpeting is a 5-year, furniture, for example. If you're doing an Airbnb, that actually goes into depending on what it is, your appliances, carpeting, furniture. For residential, that's 5-year. There are some things that are 7-year for like desks, things of that nature are 7-year. If you bought a house and you need to go put some new shrubs in the front yard or put a new fence in, that's 15-year property. And then finally, we've got the 27 and a half years, which is actually the building itself. Gets amortized over 27 and a half years. So these are the reason you've got to know these things is when you're buying property and you're putting them in service, just knowing some of these things can really save you a lot of money in taxes to do it at the right time. But that's the depreciation schedule. Keep really good record on that. That's all the passive side of the business. Now, I get really excited about is the active side of the business. And we talk about the top ways of saving money. Start a business. So this lady I was telling you about, she just retired. She retired early, and she is going to be building out her rental portfolio. That's going to be her source of income. But she's also going to be finding the properties, and her goal is to fix them up, do the BRRRR method, buy, rehab, rent, refinance. And she's got all these travel expenses and education expenses and things like that. That is all active income that if you have a business, you can write these things off. And the IRS rules are it needs to be ordinary and necessary expenses. So Code Section 162 is where you get a ton of tax savings advantages. Now, you might not need to have the LLC taxed as an S Corp right now, but anything prior to the date of incorporation, if you do have a business, we are limited to. So if you are going to start a business, perfect time of the year, I was telling you earlier, do that monthly expense report. Any expense you have prior to the date of incorporation, we're very limited. $5,000 in startup cost, $5,000 in education. From the date of incorporation forward, everything is 100% except for meals. So you hear some people say, well, as long as you incorporate by the end of the year, you'll be okay. It does not work that way. It's from the date of incorporation forward is when we get those businesses. So if you're one of those people thinking you can wait until December and then form the company, simply doesn't work that way. So this is a perfect time to do it. Now, I was telling you about my fisherman, and he had been overpaying his taxes for a very long time. He was operating his LLC as a sole proprietor. And I just used the example, if you made $100,000 in your business, and this might happen if you have Airbnbs, for example, that might be active income depending on how they're managed. $100,000 profit, that's $15,300 that you will pay into our wonderful Social Security system. If you run the same income through an LLC taxed as an S Corp, the rules totally change. The IRS rules are you must take a reasonable salary from your company. Reasonable is typically no less than 30% of your net profit. Some months are more, some months are less, but by the end of the year, I want to make sure we've given you a W-2 check of $30,000. The Social Security and Medicare drops from 15,300 down to 4590, saving you $10,000 in Social Security and Medicare. That is $900 a month that you get to keep just by having your LLC taxed as an S corporation for your active income. Now, that other $70,000, that's still your money, but the IRS allows us to pay that to you as a K-1 distribution, sometimes known as an owner's draw, which is not subject to Social Security and Medicare. So making that S election, the guy I told you about, the fisherman, I shared this with him and he said, oh my gosh, Adam, all these years, I have been overpaying on my taxes. It is sickening to think about how much he's been overpaying. And knock on wood, he didn't get audited, because the other challenge is if you do not have an LLC taxed as an S Corp, to write these things off, you have to file a Schedule C. I have a lot of different types of clients that I work with, and one of my clients is an IRS auditor. And she said, Adam, I've been auditing businesses for 25 years. I don't know how to run a business, and I really need your help. I said, all right, you help me, I'll help you. I said, I always hear about all these red flags that cause audits. I said, honestly, what do you look for? She said, two things, Adam. Number one is a home office. Number two is a Schedule C. They are both heavily abused. She said, I know that when I see a Schedule C, most people have been given no training or guidance on what they can or cannot write off, what documentation to keep, nor how long to keep it. They go to get their taxes done and they see how much money they owe. They start making up a bunch of stuff, hoping that it works. And if you have run a business, you know exactly what I'm talking about. How many miles did I tell you I drove? Try typing in 20,000 miles. Now, how much do I owe? So that's what happens. The home office, she says, heavily abused. People will pick their dining room table, put a laptop on the table and go, huh, there's my home office. Now they want to see an office, or you can do a space in your house that is used for office purpose only. But nonetheless, they want to see its office use. So we don't call it a home office. It is an administrative office in the home. So for accounting purpose, we're just calling it administrative office in the home, or just office expense. When you have the LLC taxed as an S Corp, there's no more home office, no red flag, no Schedule C. Your chances of being audited are almost zero, less than 1/4%. Now, this is kind of how we kind of build things out. In this example, this looks a lot more complicated than it is. At the bottom, we have your revocable living trust and will. We'll have another presentation another day on trust and things of that nature. But for tax purpose, that's not a taxable thing. I have your passive income in an LLC, taxed as an disregarded. That's our little blue triangle here in the top right. And then the way we like to do it, as you build out your rental portfolio, rather than having a separate LLC for every rental property, which turns into a nightmare to manage, We used real estate privacy trust. It's like a land trust on steroids. It separates the liability of each property without having to have a bunch of LLCs. Land trust have no bank account, no tax return, no renewal fee. Very simple to set up with no ongoing cost. That LLC collects the rent, pays the expenses, whatever's left, write yourself a check. Do not use the LLC checkbook to pay for your groceries, and we're good. The left side is our active income, LLC taxed as an S corporation. That is the active side of the business. My fisherman I was telling you about, I figured out that I would have saved him about $20,000 in taxes last year if he would have done the S election. Instead of giving that money to Social Security and Medicare, we could have took that $20,000 and put together his own 401k plan. You could put massive contributions into these solo 401ks. IRAs, you can put between $7,000 and $8,000. This could maybe go up a little bit this year. Last year, we could put for the solo K, we could put between $69,000 and $76,000 that we can contribute into a solo 401k plan when your business is making money. So these are things that we can do that, again, it's all designed to save you money. If you don't know about these things, you can't do them. So if you don't have a picture of this, take a picture of this because this is an awesome way to structure things. Again, we keep active income and passive income separate. My example here shows wholesaling and rehabbing as the active business. It could be any active business. Again, if you're a real estate agent or a contractor, you're self-employed of any kind, that's where that LLC taxed as an S corp really becomes important. Now, if you have partners in the business, I'll go through a couple examples. If you have partners in the business, we have a passive partnership. That LLC, we have taxed as a partnership. Each of you get a K1 distribution, and I would just take the LLC, assign the membership to you or to your revocable living trust for estate planning purpose, and each of your partners get a K1. That is for the passive income. If you have an active business, completely different structure when you have active income and you have partners involved. Now, for those of you that might be getting into Airbnbs, this is really important. So pay close attention. So we have our holding company, the LLC that's disregarded that owns the property. Airbnbs get weird because if you rent the house for an average of 7 days or less, it is active income. Just like a hotel, you will be subject to state, federal, and Social Security and Medicare. You will get crushed. But if we were to set up a holding company, your active income comes in, your hotel business, the money comes in, we pay rent to your holding company, turning that active income that was subject to state, federal, Social Security, and Medicare. Well, now we have to pay rent to your holding company, turning it into passive income where we don't have Social Security and Medicare. It's a wonderful strategy when you're doing Airbnbs. Now, this structure is not needed if you have a property manager. Now you have a property manager, you're not managing it. Now you don't have material participation. I don't care how many days it's being rented out, it is passive income. I wouldn't need the LLC tax as an S corp. So these are things that they look at is how many days was your average stay and who's managing the property. Again, important conversations to have with your tax professional because if you're not letting them know that you're managing it and what your average stays are, the CPAs generally can't give you very good advice. Now, with the example that I wanted to use for the buy, borrow, and die. So say, for example, that you purchased a house, you're going to buy it, and the after repair value was $200,000. And you negotiate and you buy the house for $80,000, and we put $40,000 worth of work into it. So total altogether, it's going to be worth $200,000, even though I put 120 grand in. Well, once I go buy the house, fix it up, get all the work done, I go to the bank and they're going to give me a loan of 80% loan to value. They write me a check for 160 grand. I bought it for 120, whether it was hard money, private money, credit cards. I bought it for 120. I was in it for 120. Bank gave me 160,000. I pay off my hard money and private money lenders or my cash that I use for that. I got $40,000 left. of tax-free money. That is the Burr method: buy, rehab, rent, refinance. We cash out refi, and now we got money in our pocket to go use as a down payment on another property. If you're sitting there with a home right now, if you've got rental properties, I talked to another guy today. He's in a great position, but he's sitting about 80% uh, equity in the property. He's only leveraged 20%. He's right now getting a refinance done. He's going to pull that cash out and go buy more property. So when he pulls that money out, that's not a taxable event. He can pull the cash out of those and go buy more properties. There's no taxes due. It's a loan from the bank, whether it's a home equity line of credit, you can borrow against life insurance, brokerage accounts. This is how wealthy people do it, because taking a loan is not taxable versus I sell the house, it becomes taxable, unless, of course, you did a 1031 exchange. So that is the buy, borrow, die strategy. And this is how wealthy people keep more of their money taking out loans. Those are not taxable. Great way to do it. Charitable remainder trust. This gets a little bit more complicated, and do not do this at home by yourself. But if you have a home or stock even, and it is a highly appreciated, the house you bought it at 200, now it's worth a million. Instead of selling it, you might consider saying, you know what? We like to do a lot of charitable work. I like to give money to charitable causes. So I would contribute that house into a charitable remainder trust. My charitable remainder trust now owns that property. When it sells that property, it now has that, $800,000 in cash. We set that trust up for a period of time, and I'm going to get a paycheck. I can even name my kids as beneficiaries to get a paycheck over a period of time. Usually it's 15 years, the period of that trust. The only catch is that when I die, or at the end of that time, the whatever's left in there has to go to a charitable organization. I've got to give it to a 501c3, a qualified charitable organization, as the final beneficiary when this trust is done or when I die. Well, what if that charitable company was a family foundation that is managed by my family? Every wealthy person out there, the Gates, Bill and Belinda Gates, have a huge foundation. The Clintons have a huge foundation. They do this and they manage these things for their charitable work, but it's managed by family. So we can really control. Now, I can't go out and pay my kids absorbent salaries to manage our family foundation. But if these are things that you enjoy doing in charitable work, you've got these highly appreciated assets that you want to put in, get some benefit out of it, and not have to pay the taxes on it. These are a great way to do it. That's the charitable remainder trust. And again, combined with the family foundation, these are things that you need to have skilled CPAs, professionals that really know how to get these things set up and operating properly. Because again, there are rules that we have to follow. But if you know what those rules are, you've got a good tax professional to keep you between the lines, we'll be in great shape. But I don't want to step over any lines. I never want to put you in a position where you're increasing your audit risk or not operating things properly, because that is the downfall. The IRS never gets you the first year. They always wait about 3 or 4 years. Then they notify you that they're going to audit you. And again, just about every audit that I have ever seen in the last 24 years, I have had one person, one that has been audited with an S corporation. And that was because he wasn't taking the reasonable salary. He was preparing and filing his own corporate return. One. Any other audit I've ever seen, 99.999% of the time, it is from filing a Schedule C. So that's just something to keep in mind. Even if your business isn't making a lot of money, I would still have it taxed as an S corp. Get rid of that Schedule C. Still lets us take the losses, write off these things, but there's just ways to do it that puts you in a better light. So that covers everything that I want to talk about today. Earlier, I was telling you we would talk about the active income, passive income. You can see now why it's so important to keep those things separate. We talked about keeping accurate records and bookkeeping, making sure that we're tracking our properties on a per property basis if we have an active business. doing that monthly expense report, tracking your meals and mileage and all these things you can do. We talked about the 401k plans and IRAs. We can put massive amounts of money in to save you money in taxes. And then finally, we talked about doing the buy, borrow, die, where we can pull cash out of properties without paying taxes on it, or putting them into charitable remainder trust and the family foundations. So Dustin had promised you earlier that we have a free list for you. We got two things for free, actually. One is scan this download on the left side. We've got the list of tax deductions. This is a list of every possible tax deduction that you can think of. So scan that and use that in, there might be things that you're forgetting that are a business expense that you just didn't think of it like that. And it is a business expense. The second QR code that we have is to scan for a consultation. So we have a team of experts here at NCH. Dustin has said we do a lot of things. Well, the backbone of our company, we form corporations and LLCs. 36 years in business. We've got over 18,000 five-star reviews. But the backbone is forming corporations and LLCs. In-house, we have a full legal department. I have one of the best CPA firms. So we do tax and accounting for business owners and investors all over the country. We have our business credit team. If you ever want to separate business credit from personal credit, we have a team that does custom business plans. We do the estate planning, the trust and wills, and we also do self-directed IRAs and self-directed 401ks. So it is all the support services for business owners and investors is what we specialize in. So please do schedule a time. Myself, and again, I have a small team of professionals. This is what we do all day, every day. No cost for us to talk with you, review how you're doing it. We might have some good advice, things that direction that we can provide for you that really will help you save a